Trillions of dollars in digital assets are currently locked in regulatory limbo, while governments deploy $53 billion to manipulate traditional currency markets. The United States is aggressively trying to dictate the terms of global finance, yet lawmakers in Washington can't even agree on how to govern their own domestic markets. The most critical piece of financial legislation on the docket is completely paralyzed. Congress shuttered its doors for August recess without a vote. That means the heavily debated Clarity Act is officially stalled on the Senate floor. Traders are already pricing in this legislative failure. Projections show the broader crypto market bracing for a steep correction, with Bitcoin potentially dropping to test the $50,000 threshold in the coming weeks. Senator Cynthia Lummis warns that failing to pass this bill now wastes 5.5 years of legislative work, likely pushing the next window for reform to 2030 at the earliest. That delay risks a permanent exodus of innovation, jobs, and tax revenue to faster-moving jurisdictions. A major psychological roadblock on Capitol Hill stems directly from the collapse of FTX. Lawmakers who previously took meetings with Sam Bankman-Fried are now hesitant to support any bill that could be framed as a handout to the industry. Democratic leaders are leveraging that caution to demand strict boundaries on digital asset ownership. They are pushing for ethics provisions designed to ensure that no government official can personally profit from the new regulatory landscape. To move the bill forward, Donald Trump agreed to a significant compromise, accepting some of the most restrictive presidential ethics guidelines ever proposed in federal legislation. Under this proposed agreement, a sitting president would be required to place all digital assets into a blind trust or divest from them entirely before taking office. To ensure compliance, lawmakers want to grant state attorney generals the power to sue the Department of Justice if federal officers fail to enforce these rules. This ethics standoff proves that the delay is as much about political optics and the fear of personal profit as it is about the technology itself, creating a gridlock that is only one part of a larger legislative war. While the politicians argue over ethics, a separate, quieter battle is playing out behind closed doors, driven by traditional Wall Street legacy banks. The conflict centers on a specific provision comparing the existing Genius Act with the new Clarity Act. Lawmakers and banking lobbyists are fighting over whether stablecoins, which are digital tokens pegged directly to the dollar, should be legally permitted to pay customers interest-like yields. Watch this deposit flight. If crypto firms offer high-yield stablecoins, customers may move billions out of traditional banks into digital wallets. To prevent this drain, lobbyists demand revisions to Section 404, pushing strict limits on stablecoin yields to ensure funding bases remain protected. Traditional banks are effectively stalling this legislation to buy themselves time, allowing them to build their own internal blockchain infrastructure before their competitors can take the lead. The paralysis in Congress over domestic crypto regulations stands in stark contrast to how rapidly the executive branch operates when dealing with traditional fiat currencies abroad. Just recently, the United States and Japan executed a coordinated $53 billion market intervention to support the Japanese yen as it reached its lowest value against the dollar in 40 years. Washington prioritized diplomatic stability over free market principles, intervening directly to support a key ally, rather than letting the currency decline further. The U.S. government moves billions with immediate precision to stabilize legacy markets, yet it remains completely tangled in bureaucratic red tape when trying to define the rules for the digital economy. With the August legislative window closed and lawmakers heading home, the final decision on the Clarity Act is now pushed to a high-stakes September vote. While the politicians wait, legacy institutions are making their moves. Top executives at massive banks continue to publicly criticize digital assets, even while their firms act as some of the largest employers of blockchain developers in the world. This chart shows the trading volume for tokenized stocks and ETFs, revealing a 288% surge in just 1 month. The institutional shift to blockchain infrastructure is already accelerating in the background, entirely independent of Washington's timeline. The current volatility is a direct result of this power struggle between legacy finance and partisan politics. When lawmakers return in September, they will decide whether the U.S. leads the digital economy or cedes control of it entirely.